Ask 10 traders what their favorite time frame is, and you will get 10 different answers. 5 minutes, 15 minutes, 1 hour, 4 hours, daily, weekly. Everyone has an opinion. Everyone has a preference, and almost everyone with absolute conviction believes that their chosen time frame is the correct one. They are almost all wrong. Not because their time frame cannot work. Any time frame can work. The 5-minute chart has made traders rich. The daily chart has made traders rich. Even the 1-minute chart, the most chaotic, noise-filled, psychologically brutal time frame in existence, has made certain traders rich. But here is what nobody tells you. The time frame itself is not the variable that determines profitability. The relationship between the trader and the time frame is. And there is one time frame, one specific approach to time in trading that creates the most favorable relationship for the most traders. A time frame that reduces noise without sacrificing opportunity. That provides enough time to think without requiring you to stare at a screen for 16 hours. That aligns with how institutional money actually moves. That gives your analysis room to be right, even when your timing is slightly off. Most traders ignore it completely. They are seduced by the speed of the short time frames or intimidated by the patience required by the long ones. And they pay for that choice, trade by trade, week by week, year by year. This article is going to end that. By the time you finish reading, you will understand time frames at a level that most traders never reach. And you will know exactly which one gives you the highest probability of consistent, sustainable profitability. First, why most traders choose the wrong time frame. Before revealing the answer, we need to understand why the wrong time frames are so seductive. The seduction of speed. When a new trader opens a trading platform for the first time, the short time frames are always the first thing they gravitate toward. The appeal is obvious. On a 1-minute chart, there is always something happening. Price is moving constantly. Candles are forming every 60 seconds. Opportunities appear or seem to appear every few minutes. The action is relentless, exciting, and generates the dopamine response that the brain associates with engagement and progress. This feels like trading. It looks like trading. It has all the visual drama of trading. But for the vast majority of retail traders, it is not profitable trading. It is expensive entertainment dressed up as a business. Here is why. On the 1-minute and 5-minute charts, the ratio of noise to signal is catastrophically high. Every tick of price movement, every institutional algorithm adjusting its quotes, every market maker managing their spread, every automated system rebalancing, shows up as a candle on these short time frames. The actual signal, the genuine directional movement driven by real supply and demand, is buried under an avalanche of meaningless noise. Trading this noise is not analyzing the market. It is gambling on randomness with a thin veneer of technical analysis painted over it. The intimidation of patience. On the other end of the spectrum, the weekly and monthly charts intimidate most retail traders out of using them. A weekly candle takes 7 days to form. A monthly candle takes 30. By the time a setup develops, forms, and provides an entry signal on these higher time frames, weeks or months have passed. For traders who entered the market seeking excitement and fast returns, this pace feels impossibly slow. And so they abandon the higher time frames where the clearest signals and the most reliable trends live, in favor of shorter ones where the action is constant and the losses are frequent. The time frame that actually works, the daily chart. The answer is the daily chart. 1 candle per day. Each candle represents an entire day of price action. The open, the high, the low, and the close of a full trading session. I know what some of you are thinking. The daily chart? That is basic. That is what beginners use. This is exactly the misconception that keeps traders stuck on the wrong time frames. The daily chart is not basic. It is not simple. It is not for beginners. It is the primary time frame of every major institutional player in financial markets. Hedge funds, investment banks, proprietary trading desks, the entities that move the most money and generate the most consistent returns, build their primary analysis on the daily chart. And there are specific, logical, structural reasons why. Why the daily chart works, the complete case. Reason 1, it eliminates noise without eliminating signal. Every financial market contains 2 types of price movement: signal and noise. Signal is genuine directional movement driven by real changes in supply and demand, the kind of movement that sustains trends, respects key levels, and can be analyzed, anticipated, and traded profitably. Noise is random fluctuation. The constant micro-movements of price caused by order flow imbalances, algorithmic adjustments, and the billion small transactions that occur in any liquid market every day. Noise has no predictive value, it cannot be analyzed, it cannot be profitably traded on a consistent basis. The daily chart filters out the overwhelming majority of noise while preserving virtually all of the signal. By compressing an entire day's worth of micro-movement into a single candle, it removes the randomness and reveals the underlying directional structure. A hammer candle on the daily chart represents genuine rejection of lower prices by buyers over an entire trading day. The same pattern on a 1-minute chart represents a 20-pip price fluctuation that means almost nothing. The daily time frame gives your analysis something to actually analyze. Reason 2. It aligns with institutional money flow. This is the reason that matters most, and it is the one that most retail traders have never considered. Markets move in the direction that institutional money is flowing. The direction of institutional money flow is the direction of the trend. And institutional money, the money that moves markets, is managed and deployed on daily and weekly time frames. A hedge fund manager does not make position decisions based on what the 5-minute chart is doing. They analyze daily charts, weekly charts, fundamental data, and macro conditions. Their entries and exits happen at levels defined by daily and weekly price action. When you trade the daily chart, you are trading in alignment with the same levels, the same patterns, and the same structures that institutional participants are watching. Your support and resistance levels are their support and resistance levels. Your trend analysis aligns with their trend analysis. This alignment is not a minor advantage. It is the difference between trading with the largest, most well-capitalized players in the market or trading against them on a time frame they do not care about. Reason 3, it gives your analysis time to be right. One of the most underappreciated aspects of time frame selection is the time it gives your analysis to play out. On a 1-minute chart, if price moves against your position by 10 candles, you have been wrong for 10 minutes. On most short time frame systems, this is enough to trigger a stop loss, close the trade, and count it as a loss. On the daily chart, if price moves against your position for 10 candles, 10 days have passed. During those 10 days, you have had the opportunity to assess whether the contrary movement is a genuine reversal of your thesis or simply a normal retracement within the trend you identified. More importantly, on the daily chart, a normal retracement does not look like a reversal. It is clearly identifiable as what it is, a temporary move against the primary trend that represents a buying or selling opportunity, not a signal to exit. This distinction between retracement and reversal is almost impossible to make on short time frames because the noise makes every small move look potentially significant. On the daily chart, the structural clarity is sufficient to make this distinction with confidence. Reason 4, it protects your psychology. Trading psychology is destroyed by short time frames. This is not an opinion. It is the consistent experience of traders across decades and markets. On a 1-minute chart, a trader can experience 10 wins and 10 losses in a single hour. The emotional volatility of this experience, the rapid cycling between confidence and self-doubt, between excitement and anxiety, is psychologically exhausting. Over days and weeks, it accumulates into a state of chronic stress that degrades decision-making, increases impulsivity, and makes consistent execution of a system almost impossible. The daily chart imposes a natural rhythm on trading that protects psychological stability. You analyze in the evening or morning. You set your orders. You check in once per day. The rest of the time, the market runs without your involvement and without your emotions interfering with your positions. This enforced distance between trader and trade is not a disadvantage. It is a psychological advantage of the highest order. Reason 5. It fits real life. This point is practical but critically important. Most traders are not trading full-time. They have jobs, families, commitments, and lives that exist outside the trading platform. The fantasy of sitting in front of a screen all day watching 1-minute charts is not compatible with reality for the vast majority of people who trade. The daily chart is. You need 15 to 30 minutes in the evening to analyze your watch list and set your orders for the following day. You need 5 minutes in the morning to confirm or adjust. The rest of your day is free. This compatibility with real life is not a secondary consideration. It is the reason that swing trading on the daily chart is the most sustainable approach for most traders, because it can actually be maintained consistently over months and years, which is the only time frame that matters for building real wealth through trading. How to trade the daily chart. Complete system. Understanding why the daily chart works is only half the knowledge. Here is exactly how to trade it. Step 1. Weekend analysis. Sunday evening. The most important trading session of your week happens when the market is closed. Every Sunday evening, spend 30 to 60 minutes analyzing your watch list on the daily chart. You are looking for 3 things. First, the current market structure. Is each asset on your watch list making higher highs and higher lows? Uptrend, lower highs and lower lows, downtrend, or oscillating between equal levels, range. Second, the key levels. Where is the significant support? Where is the significant resistance? Where are the levels that have been tested multiple times and shown their importance through repeated price reactions? Third, the developing setups. Which assets are approaching key levels? Which ones are showing signs of a potential reversal candle at a significant level? Which ones have the structure that your trading system requires? This weekly analysis session creates your trading plan for the coming week. You enter the trading week knowing exactly what you are looking for, on which assets, and at what price levels. Step 2. Daily check-in, evening or morning, once per day. Either in the evening when the daily candle is closed, or in the morning before your session opens. Spend 10 to 15 minutes checking your watch list. Has any asset reached a key level you identified? Has a reversal candle formed at a significant level? Has the market structure you identified on Sunday changed? If a setup has developed a clear reversal signal at a key level in the direction of the dominant trend, you prepare your order. If no setup has developed, you do nothing. Watching and waiting is trading. It is the most important trading activity and the most undervalued. Step 3. Entry criteria. Your entry on the daily chart requires 3 elements. The same confluence rule that applies across all time frames, but with the added weight that daily candle confirmations carry. 1. The dominant trend is defined by market structure on the daily chart must support the direction of your trade. In an uptrend, you only look for longs. In a downtrend, you only look for shorts. 2. Price must be at a significant key level, a level that has shown its importance through previous price reactions, moving average levels, or structural significance. 3. A daily candle must confirm the setup. A hammer, bullish engulfing, or pin bar at support for long entries. A shooting star, bearish engulfing, or pin bar at resistance for short entries. All 3 every time, no exceptions. Step 4. Risk management. Stop loss. Below the confirmation candle's low for long entries. Above the confirmation candle's high for short entries. The daily candle that triggered your entry defines your risk. Position size. Maximum 1 to 2% of account at risk per trade, calculated based on the distance from entry to stop loss. Fixed, non-negotiable. Take profit, the next significant key level in the direction of your trade. Do not move your target based on how the trade is progressing. Let price travel the full distance between key levels. Step 5. Trade management. Once the trade is entered and orders are set, your job is minimal. Check the trade once per day when the daily candle closes. Ask 2 questions. Has my stop loss been hit? Has my take profit been reached? If neither, do nothing. The trade is running according to plan. Do not exit early because the trade has been open for 4 days. Do not move your stop closer because you are nervous. Do not reduce your target because you want to lock in profit. The daily time frame requires patience. The setups are fewer than on shorter time frames. The trades take longer to develop. And the profits, when the system is followed correctly, are substantially larger and more consistent than anything the shorter time frames can deliver. The multi-time frame approach, the professional method. While the daily chart is the primary trading time frame, professional traders do not use it in isolation. They use a top-down approach that incorporates multiple time frames, but always with the daily chart at the center. The weekly chart, used for context only. What is the dominant trend on the weekly? Where are the major support and resistance levels that have held for months or years? This context defines the directional bias that governs all daily chart analysis. The daily chart, the primary analysis and entry time frame, all setups are identified here, all entries are confirmed here. The 4-hour chart, used for entry refinement only. Once a daily chart setup is identified, dropping to the 4-hour chart can provide a more precise entry point within the daily candle structure, potentially improving the risk-reward ratio of the trade. This 3-time frame framework, weekly for context, daily for setup, 4-hour for entry, is the approach used by the most consistently profitable retail traders in the world. Conclusion: stop chasing speed. The trading industry sells speed, faster execution, more trades, more signals, more action. This is not what creates profitability. It is what creates the illusion of activity while systematically destroying accounts through excessive transaction costs, emotional decision-making, and the relentless grind of fighting market noise. Profitability comes from clarity, from analyzing markets where the signal is visible and the noise is filtered, from making decisions with time to think, in alignment with institutional money flow, at levels that matter to the participants who actually move markets. The daily chart provides all of this. It is not the exciting answer. It does not promise 40 trades per day or the adrenaline of watching 1-minute candles fire in real time. It promises something more valuable, a genuine structural edge traded consistently over time with the patience and discipline that real wealth in the markets requires. Most traders will read this and return to their 5-minute charts. The ones who act on it, who genuinely commit to the daily time frame with a complete tested system and the discipline to follow it, will find themselves in a very different position 6 months from now. That is the only time frame that actually matters. Drop a comment. What time frame are you currently trading, and has it been working? Tell me honestly.